has keyed in that we are going to get probably 2 more cuts for the remainder of 2025, and then we are off to 2026. It's a weird market out there. We've got a lot to talk about. We've got Bitcoin down here today, S&P 500 and Nasdaq sitting at all-time highs. Though under the surface, there is some interesting things. I was mentioning this to Chris. We were talking a little bit about the breadth of this market looking pretty rough. Take a look at the RSP. This is the equal weighted S&P 500 ETF. You can see it has pretty much remained unchanged for the last few months, despite the Nasdaq, due to the tech stock rally that we're seeing, continues to bolster to all-time highs. Gold and silver pulling back here. It's an interesting market. Chris, what are you watching?
A little bit of everything today. Gold, silver, indexes, of course. I did post a trade this morning for Pulver alerts. I actually took this yesterday on my YouTube session and carried that over. I am going to call a bit of a short-term top here, Nick. And so I'm playing an option strategy. I'm doing a broke wing butterfly where as long as price stays below 70.50, I've got a pretty good opportunity to make some money by next week. It's technically the 10th of November. So we'll go into next week, which I think Friday, everything again is tentative. So we were supposed to have manufacturing PMI, services PMI, ADP numbers, and non-farm next week, but it's all tentative. So we don't know if we're actually going to see this data next week or not. I don't think it really matters, honestly, but this is Mag7 earnings, big, Meta, Microsoft, Google, Amazon, Apple, FOMC, PCE, all this stuff is being digested this week. So my thoughts on this whole trade were market makers know this stuff. Efficiency theory. I mean, I'm kind of a efficient market theory believer, especially when it comes to options. So I'm going out mechanically to levels that I think shouldn't be tested. All this news is taken into consideration, even if we're going to see the market continue to rally. When we saw 3 gaps this week, literally from Friday to Monday, Monday to Tuesday, Tuesday to Wednesday, we've seen gaps every single day. And it's a pretty decent push here these last couple of days. And all it was is we had Trump taco back on the 11th. So we had the 10th sell-off over the weekend. He tacoed. And then after that, it's okay, so we have the Apex Summit coming up this week as well. And it's all right, man, if market makers are going to do their job and they're just delivered with all this volatility and all this potential news, I think they price it in. So I'm taking a chance on a short-term top and seeing if I'm right. Also, 7,000 could be a nice round number target to maybe have some resistance. Also, the 50-period moving average still stretches into the 120 bars where we haven't touched it yet. And we also pushed nearly 300 points higher in the S&P over that 50-day moving average. So, I'm calling a bit of a short-term top. It's a defined risk trade. We'll see if we're right.
Yeah, it's been an interesting couple weeks, just considering, when it comes to the state of this rally, it's hard not to say that, the markets are looking stretched here. Just take a look at the Nasdaq, look at the Dow Jones.
I mean, NVIDIA is the reason, dude. NVIDIA is cranking to the upside. And I mean, yesterday it was up 5%. Today it was another 3-4%. That is we're going to be talking about this at 5 trillion, right? It's got to be close market cap wise.
Yeah, I think it's close, and we also have Apple, I think, joining the 4 trillion club pretty soon.
Apple, Microsoft are both getting close. I think here, let's look. Apple is let's see here, 4.01 on Apple right now.
There you go.
502. Wow, $5 trillion market cap on NVIDIA. Crazy.
It's difficult. What's difficult here for me today, Chris, is with this
Microsoft.
With this Fed meeting, what are we looking for? I mean, you said it when you jumped on here. Pretty much the expectation by the market is that, okay, we're going to get a cut today. We're expected to get a cut in December. But I've seen some ideas.
But you know why we're cutting? We're not cutting because of inflation. We're cutting because of jobs. And speaking of jobs, I brought this up. So this is Kobayashi letter, whatever. They're super bearish most of the time. So, but recent layoff announcements. UPS, 48,000. Amazon, up to 30,000 employees. Intel, 24,000. Nestle, 16,000. These are Walmart cutting jobs, Amazon cutting jobs, UPS cutting jobs. Look, UPS popped to the upside. We had a double-digit rally in UPS. I have a ratio spread that's up 80% right now. Accenture, 11,000 employees. That's a huge insurance company. My concern is that these jobs, Nick, are probably not coming back. That's what scares me. It's companies are getting gains in Wall Street because they're laying off workers because it's going to be better for their bottom line. It's the U.S. People love the U.S. markets because we put corporate like priorities and corporate greed and corporate profit over the well-being of the workforce and the well-being of our employees. And I mean, we are gutting the labor force and it's making money on Wall Street, but it's like, I don't think these jobs come back, not anytime soon. And yet we're rewarding these companies for it. So this is real, man. Like, this is what's happening under the surface. The Fed cutting does have some concerns. I don't know. I know you and I will talk more about it offline, but I think that I'm just extra cautious going into 2026. I think it could be like a very sideways year at best. I really think that the important thing right now with this week, especially, is this AI narrative. It is like blinders are on. Nobody's recognizing all the bad stuff that's happening. It's just like blinders on, all systems go. Let's go AI build out. As long as these companies are doing it with cash and not doing it with debt, I think it's okay and the narrative stays intact. But I think what this shows is if there is a flinch by Mag7, I think this unravels a lot quicker. With, we're talking, equal weight is not performing the same. Market breadth is not participating in these highs, and that usually leads to some fragility underneath. So I just think that we're being dragged to the top by these amazing companies, and that's awesome. But it's also really scary because at some point when they flinch, it drags everything down pretty aggressively.
Yeah, it's true, right? In terms of the breadth of the market, you have very few companies leading the charge. And the storybook, if history is a lesson with new technologies, there is, I know a lot of people love to say like this time is different, in terms of this technology is going to change the world forever, but people literally did that with the internet. And It's interesting because new technologies, there is sort of a blueprint here in the sense that people with new technologies, like these new technologies, the internet, electricity, AI, these things change everything about the way our society functions. They're incredible innovations. These companies that are doing this, they're building some of the most, tomorrow's stuff today. And it is very cool. The thing that, the blueprint for it though, is that people have a tendency to overhype and pull forward a lot of the progression. And in terms of job loss, I would agree. I think the blueprint is pretty clear in terms of new technologies, which is everyone fears that we're going to all lose our jobs and we're never going to have jobs. That's actually not something new to AI. That was something on the internet, to electricity. Again, new technologies beckon in this initial doomsday where like we are all going to lose our jobs and nobody's going to be able to work and nobody's going to be able to do anything. And what usually actually happens is in the short run, new technologies, as they take root and kind of build into society, the first thing they do is, yes, they do actually cannibalize old industries and old jobs and take away from those existing, workforces. And then longer term, whole new industries get created, whole new jobs get created. And I think that's probably what AI is going to look like, in my opinion. What that leaves, though, is this big question of like, are we going to have this period where you have this melt up and excitement around AI that also leads into sort of a job destruction period, which could leave us into a period. I mean, even if you build all this innovative stuff, if everyone loses jobs, where's the consumer? The consumer is out on the street. So who's going to buy all these things that, we're automating?
I mean, that's your more dystopian conversation around universal basic income, because we'll have companies that make so much money that do so much more with nothing but AI. And we're generalizing here, but for the most part, if people are left displaced, it's like, yeah, we don't have a consumer. So give them universal basic income, hope that there's deflationary forces to make things cheaper, and then just there's a government to support it, and there's crazy high corporate tax rates to keep people alive in a society doing something, consuming something. I do have a couple charts I wanted to share. This bubble talk's been high in the press, and I think that's the reason it's not happening. This AAII sentiment every single week, the NAAIM sentiment survey every week, like they're still not painting like everyone's bullish. Like the bears are still persistent in the themes out there. And when sentiment remains bearish, like I know we keep saying this, but it is proving to be true, like week after week, the upside is probably the most risk. So, I mean, I think shorting the market right now is silly. And I'm literally saying that like I just took a short, but it's based on a 2-week position. I'm only risking $850 if I'm dead wrong. But I think mechanically I got a pretty good chance of the market just sideways here, stumbles. Like it's got to get above 7,000. It's got to gain another, couple of percent to do that. But this chart here, S&P 500 price earnings ratio below the .com levels. Like I said, a lot of the .com stuff, the valuations were insane, where they were companies that didn't even make revenue, had, just crazy high, like 50 times earnings, 100 times earnings, 100 time price to sales. And it was just like unicorn valuations, and they were just totally fake. And then there was fraud underneath, and there's your Enron and other stuff that got uncovered. Those were the cockroaches back in the .com bubble. So anyway, we're not there yet. And we've also seen like a steadier run since 2008, 2009, a steadier run that's been a nice gain. And again, it's led by companies that have ridiculous amounts of cash, 5 trillion Nvidia, 4 trillion Apple, 4 trillion Microsoft, and there's others like the other, 7, I guess. We've got $1 to $3 trillion companies. Here's another one. Are we in a bubble valuations in .com bubble versus today? These are your, big blue chip stocks during the tech bubble. So Cisco, Oracle, Microsoft, and Intel, names that are still around today, but they were also crushed percentage wise. Like we're talking 60, 70, 80+% drawdowns during the .com bubble. And you look at the price to earnings today, Microsoft at 32 times versus 60 at the .com bubble, Apple at 32 times versus all these at 47 up to 100 plus price to earnings. Nvidia at 31 times earnings. I mean, the crazy part about Nvidia is the forward PE actually looks enticing. Like it actually looks like it could sustain this for the next couple of years. The demand is so high for Nvidia right now that I think that we could probably stretch this Nvidia valuation into like 2026, 2027 before it kind of slows. But again, I think that the AI narrative overall has to remain intact, and there can't be a flinch by anybody. You can't have a flinch from NVIDIA. You can't have a flinch from Meta. You can't have a flinch from Microsoft. You can't have a flinch from Google. You can't have a flinch from CoreWeave or everyone that's like woven into these webs of AI stuff. They've got to be perfect. And I think that's, it's a doable path, but I think it's also very, very tricky and very volatile ahead. I've got one more, I think, here, Nick. This one is the largest stocks traded at valuation roughly 29 times. So a lot of your Mag7 stocks valuations are 30 plus. But going back to the .com bubble, so you have the crazy largest stock valuations at 50 times earnings compared to now at 29 to 30 times earnings. So even the largest stocks out there are not like ridiculously overvalued like they were back in 2000, 2001. So I just thought it was interesting, like kind of the anti-bubble data that I'm like, all right, I can wrap my head around that, as this maybe has some more legs to it. But sentiment's really weird. We have it in the Edge Finder. The sentiment continues to print bearish. I'm curious what this reading is going to be today, if we're still at 40+% bearish sentiment, or if it flips again. We had like a big drop in the bearish side not too long ago and a big jump in bullish. We'll see, man. But 7,000 could be a nice, interesting round number. That's just around the 20% handle for the year. We're talking like a run like we saw back in the 90s, when you stack together 1, 2, 3 years in a row, 20+%. That's the 90s. Yeah. I guess it can keep going, but I mean, volatile. There's got to be some volatility ahead.
Chris, it's one of the more unique times that I've ever traded, because I've never, I would come to a frustratingly similar conclusion as well. It's really hard for me to, I'm by nature sort of contrarian in markets. Like I want to, if everyone's zigging, I want to zag, and vice versa. But to your point, let's just take a look at some sentiment tools, because again, I would agree with your sentiment of the risk is to the upside. I think you could have some really ridiculous upside squeezes. Maybe this week, maybe next week, maybe by end of year. It's hard to say, but
right.
It's very hard to time that. And here's the thing. Part of the reason that you've mentioned this investor sentiment survey here is still bearish. Like if you take a look here, this is showing that in this market where, the market's going straight up at all-time highs, you still have a lot of sentiment that is negative in this market. And one of the common things that I've heard people say, and I kind of agree with this, is that, when you're in a bubble, there's not people really wondering if you're in a bubble or not. It's just everyone's long, and PE ratios are at ridiculous levels. Mm-hmm. And while PE ratios are not cheap by any means, are they in like absolutely horrifyingly high levels? Not really, for some of the big leaders like you just got done discussing. That was a great chart, right? Comparing the leaders. So again, does this mean that I go out and I say, I'm leaning in leverage long on the AI unprofitable ARK ETF? No. but it does mean for me that like I can't justify getting short. I can't justify going all cash, but I can justify the idea of like, as this thing legs higher, if it does continue to be, a runaway melt up market, if that's what we're going to go into, I'll tell you what my plan is. And I imagine, Chris, just knowing you for this long, I imagine you're probably in the same camp. It's like, okay, the more it wants to run, the more I'm going to get slowly, progressively more defensive, because it does not go on forever, and it may go on longer than we think.
For
may
sure.
go on for another year or 2 years. But
yep.
Yeah, I think we got to play a little bit more defensive, the more, and especially as this thing actually does shift into bubble-like looking things. Here's one more sentiment chart just to go off of that. To be fair, put to call ratio, as we've melted through these highs, has gone off the chain, where bulls are back.
Yep.
High levels of call volume. So we haven't gotten AAII investor sentiment survey. This is going to suggest or make me guess, Chris, that tomorrow when we get that, it's going to be a little bit more bullish than it was the week before. We've had just a melt up here in the chart on the S&P 500. Probably going to see a little bit more bullishness.
And that's fine. That call ratio is really interesting. I think that this week, when it all settles, plus we have US data, the PCE numbers that come out at the end of the week. We had CPI that was warmer, not overcooked. But look, we have to have inflation. Let me ask you this, Nick. Do you think that the data that we're getting is really trustworthy and reliable? And I don't know if this is like all part of the master plan, is just like, let's do a government shutdown. Let's make everyone question the integrity of the data. Nobody knows what the job numbers really look like. It's like, if we get non-farm payroll next week, do I trust that number? Probably not. It's like, it's been 30 plus days since we've had a non-farm payroll number. Is it valid in like what non-farm is now? Is it a month or two ago? Like, I don't know.
Well, if there's anything we've learned, Chris, with the non-farm payroll numbers, is they revise them like crazy a year later. So it's hard to trust anything.
Yeah. Even a month. I mean, even a month later, it's like those revisions they're swinging, 50K revisions are ridiculous. So anyway, and it's all tentative next week. We might not get it. We might have the longest shutdown in history. We might have the market rip into all-time highs. We might have another stretch where we hit 20+%. Look, man, looking at the charts, I mean, here's MAGs. Let's go to SPX. I think the one thing that does bother me about that October 10th sell-off is, I know you did position for a Friday play, correct? You positioned something long on Friday. You did
for S&P 500 stuff,
for S&P or Nasdaq. Like, did you do anything that Friday at the end of the day?
Oh, I did. I bought NAS. I'm still, like, that's what I'm saying. I'm still very much long on a bunch of stuff here. Still, I still have some individual stocks, but yes, I'm still positioned long. And just one real quick point before I throw it back to you, Chris. This is an interesting point that I think is worth mentioning. Take a look at Pfizer. This is of course, one of the contracting companies out there. We have Accenture, the staffing companies. Just to your point about labor data and how, we can take a look at some of the stocks that, of course, have some data that, trust no one further than the private, sector to really look at their data. And staffing companies have been showing some signs of weakness in the jobs market. Granted, you've had other areas that are showing lots of growth, but again, labor statistics wise, I do think it's probably, there's some red signs or red flags flashing when it comes to labor stats, but tricky because there's also a pushback. Did you see the ADP numbers started coming out weekly? Did you see that?
No, I thought they were just on the calendar for next week.
No, there's they did. I don't know if it's on Forex Factor just yet, but I saw this morning. ADP numbers are going to start reporting weekly. Those guys, whoever's running that, they are on top of it because they're filling the gap of that unemployment claims. I don't even know where to find this. Someone in the chat, let me know if you know this number, but ADP started putting out a weekly statistic on jobs data.
Weekly labor data. See if we maybe it's just on their website.
Maybe.
Let's find out. ADP announces National Employment Report preliminary 1 day ago.
New weekly. Yeah, I know it's a weekly new kind of pulse on jobs, just like the unemployment claims. I believe it's Tuesdays.
Okay. That's, great. At least we have something. We have something to go off of. So
there's season today. That's just
so
smart.
weekly preliminary estimate, monthly report. So 11/5 monthly, weekly preliminary estimate on weekly. What's the 11th? That's going to be a Tuesday, like you said. So every Tuesday, preliminary estimate, and then monthlies will be like the first Tuesday of every month, I guess, first Wednesday. Okay, good for them. Yep. Give us something. I mean, non-farm and BLS, I mean, they fired somebody that was the head of BLS and now it's somebody else, and the numbers still don't make any sense. And there's revisions every single week anyway, or every month anyway. So we haven't seen job numbers since ADP. That was back in literally the 1st of October. So it's, I mean, we've had a 30-day blackout from any real data outside of our one print and CPI we had last week. Anyway, man, look, I think the upside is real. I don't like how price has been behaving these last couple of days just because of the stretch away move. Look, I think we could have FOMC today. Let's just talk real numbers. Okay. FOMC today, I think we have a lot of potential noise. If we come back up to like 69.15 or hit like 69.20, 25, that's where I could see prices going today as far as like the upside. I do wonder if it's like a noisy, choppy, contained day, like maybe plus minus 30 on the day for S&P. But do we roll over in any capacity and fill these gaps? I mean, technically, if you look at the futures market, there is going to be a inefficiency going from like Friday's close, but getting here, gap, the way this has been running up and melting up. I mean, it's pretty much been carried by NVIDIA. I mean, yesterday we had 60% of stocks in red for the day, and we were sitting at all-time highs. Today is not much better. I don't think the market breadth is much better today. We actually dipped lower in market breadth today. We have 52% of stocks down in red today. Again, carried by NVIDIA to the upside, Google, some of the big ones. Taking a look at market breadth here. Let's go S5. This one. This took a nosedive. So we have 47% of stocks, or I'm sorry, the S&P 500. There's only 47% of the S&P 500 that's over a 50-day moving average. So technically, your industry standard 50-day moving average, 200-day moving average. This is now suggesting that 53% of stocks are entering into a correction zone. Like it's an indecision zone, right? We need to get this above 50%, show, okay, we have a healthy buy zone for most of the stocks out there. You go to the Nasdaq, this went from 70+% all the way back down to 64%. So it's still healthy, but tech's kind of had the big juice here the last little bit. Let's talk just AI briefly for a moment. Nick, do you want to chase individual tech stocks, or do you want to trade like energy or utilities or something that like benefits from the physical build out of AI?
I mean, I'm definitely the further it goes up, the more I'm in the rotation camp of like anything but tech stocks. I'm looking at with a little bit more interest, even bonds, precious metals, international stocks. I just want to spread out because again, I've been on the right side of a lot of the AI stuff.
Yep.
But it's making me more and more nervous. The more one directional it becomes, especially if you get some chase into the year end, I mean, you could get some serious froth. And I think that's a real risk. I think if when it comes to November and December, Chris, I think that the chase for performance 9 times out of the last 10 years, November and December have been strong periods in the stock market.
Right.
It's tricky to try and fight that, but you pointed it out earlier. Does that set up a 2026 that could get dicey, especially with midterm elections? I mean, I think there's some serious transitioning towards like being a little bit more defensive in 2026 that I'm going to personally be looking into.
Yeah, actually, I was just curious on my own accord, looking to see. So I've talked, on these sessions and my YouTube stuff and some of the trades that I do. If I ever am in doubt with, hey, I want some upside appreciation or I want some gains, but I want downside protection, I'll buy shares and I'll do a collar trade. I was looking at doing this on IBIT. So this is the BlackRock ETF. I looked at a trade today that if I bought shares around $63, so let's just say I buy at market right now, I could do a $64 or $65 covered call. That covered call can save you about $15 on this position. So that gives you a buffer here, Nick. If I were to buy shares of IBIT right now and sell a covered call that's out a year, I can get my cost basis down to about $48. I don't think that's a bad trade, to be honest, because that takes into account about a 30% correction. Now, granted, things can get worse and things can go down. But I also think that's a heck of a good way to generate about 20+% return on investment by just, Bitcoin can go to the moon, but I've got a solid like 20+% locked in because I just went from 63 down to 48 and it just gets called away. Part of me for the conservative side of me is pretty interested in a trade like that because the premium is so juicy that I might just do that for a little trade in my, like some of my retirement accounts. I've got some Bitcoin exposure through IBIT and I trade some options. I think that might be a pretty safe way to do it. If I wanted to have more protection, then I can sell the call and buy a put and obviously do the math on that break even and then manage the downside by the long put side versus just selling the at the money covered call. So just throwing it out there. You might see that pop up in Pulver reports as like a campaign trade where I'm like, look, here's what I'm going to do. Say it's a $25,000 position. I'm going to buy, $22,000 worth of shares, spend a couple grand on hedging and figure out what I want to do with my credits. And hopefully that is a, pretty good return. I'd like to do it heavier, but I'm also not going all in on anything. So I think diversification is going to be important. I asked about the AI stuff are you chasing stock companies by themselves or are you going into the rotation stuff? My boring way to trade AI is buy energy, buy utilities, buy materials, buy commodities, gold and silver, Bitcoin. I think those are to me like that's how I'm going to trade AI. I'm not going to be searching for the, mom and pop, tiny little small cap semiconductor company that's up 300%. Like that's cool. But I can promise you that company is not going to be anything more than like a blip on the radar. Like it's going to be a pump and it's going to fade. Like that's the one thing that has me the most concerned is stocks like, I'm trying to think, is it Go? Like what am I thinking of? Some of these like quantum computing or anything in AI that's they're up like 900%.
Look at like QTUM, you have BE, you have all these exciting stories, but they just are like, they don't make any money. Like they're just hype city. And that concept, Chris, of your idea of like, okay, you want to get more defensive, you want to buy dividend stocks, you want to buy energy stocks. Like if that's like your direction that you're interested in, listeners, you got to understand, like those things still carry risk too. Because if you get a true Nasdaq sell off, if we get a true like, okay, the AI trade is losing steam, everything goes down.
They'll be down 90% versus the Nasdaq might be down 30%, but the individual stocks that led to that ridiculous valuation and stuff, when it turns, those will be down. I mean, 2022 is a good example. If anybody trade through 2022 in individual stocks, even the Mag7 was down 40 to 70% in 2022. Yep. That is volatile. So yeah, big positions in Meta down over 70%. Meta washed away almost a decade worth of gains during 2022. So
exactly.
Anyway, I've got an interesting comment. So I think that the most wealth is created as investors, as traders, if you are able to have liquidity, able to have dry powder in and around the bottoms. I heard that from the guy's name. I think it was David Rosenberg. He was on Thoughtful Money podcast this last week. I was at the gym on Sunday. I caught it, but I just thought it was a good point. Like all bubbles end the same. At some point, like it will turn. At some point, it'll get nasty. Also want to share this. This, Nick, when you're talking about drawdowns. Let's see if I can go.
Yep, the drawdown math.
So I was talking about this in one of my morning sessions. I mean, look, I'm not saying that we have to have this ridiculous correction. Okay. But what I wouldn't be opposed to is if this market has another 20 to 30 to 40 to, heaven forbid, a 50, 60, 70% correction. But what I want to pay attention to is if we have those type of corrections, if we just had dry powder to just take bite, it doesn't even have to be picking the bottoms, man. It's just if we have dry powder to participate in the little bit of capital at the 20% correction, a little bit of capital at the 30, 40, like every one of these levels allocate like a 5% of my account, 5% of my account. I don't know if I get fully invested by doing this, but if I'm investing, let's say another 10, 15, 20% of my dry powder, I mean, the amount of returns to the upside are pretty fantastic. If we have a 50% drawdown on the markets ever in the next 5 or 10 years, well, eventually it's going to get back and that's 100% gain to the upside. Nobody wants to have the lost decade, of course, but I just think this is why I have dry powder. Because I don't know how ridiculous things get. I don't know how nasty things get to the downside, but I don't know. And I hate to be that pessimistic. I'm not. I just think that if you're calling the top right now, you're going to get, it's like picking up nickels in front of the steamroller. That's what I keep hearing people say. Because calling the top. They're just crushing people. Also, I mean, I trade 0 DTE. I trade lots of options. I'm looking at like the efficiencies of the market. Dude, it is crazy to see like every single week or every single month, the market is just pushing through those, what should be high probability, like resistance levels. The market's just testing for the last 3 quarters, by the way, for the last 3 quarters, with the the April bottom, we have been pushing to the upside of the JP Morgan collar trade.
Interesting.
Every quarter. I'm sorry, man. I just realized it's 2:00. So let's talk some FOMC.
All good. Yeah, no, we just had 4% come out as expected.
Yep.
If you are wondering why didn't we get a big move, I explain this every time, but basically we got 25 basis points cut in terms of the federal funds rate. This was largely as expected, meaning the market already priced it in, meaning before this happened, people already knew that was what was going to happen. And that's why you're not really getting big moves. Remember that, as always, usually the big moves happen at the actual press conference, which will take place in about 28 minutes from now. So please understand, you're not getting big movements because we got the rate cuts that everyone expected us to get. People ask this question every single month. They say, well, Nick, they cut rates. Why isn't gold exploding higher? And it's because gold and the Nasdaq and everything else already expected what we got.
Right.
If we had gotten a 50 basis point cut or a 0 basis point cut, that would have been a surprise to the market and caused sharper moves. So again, the bigger moves are what's coming in 30 minutes, which is where we will hear from Powell, who will give us some indications potentially of what the Fed is looking more likely to do as we close out 2025 and go into 2026. If he signals that the Fed feels like, okay, we should probably not cut rates too many times, that's going to send the dollar higher, gold lower, stocks lower, etc. And vice versa. If he signals, hey, we still think there's room to cut, we still think we're restrictive. If he signals more rate cuts, if that's what the market hears from him, that's where stocks will rally, gold will rally, dollar will drop. So it's really about the press conference. It's not about the release of the data. The market has already expected the data long before today.
Yep. It's going to be the guidance that Powell gives. So I think what the market's going to be looking to take away from his press conference is, can they, glean any information about, is the Fed going to continue to look softer and dovish into 2026? What does the probability show on the Fed watch tool right now? Let's find out. I know they're planning on another cut in December. That would be the 19th. Is that right? Does that seem right?
Sounds right.
So we've got the 29th today. I think it's December 10th or December 19th. I'm not sure. I'm going to try to figure that out. It might be
December 10th, actually.
Yeah, I think that sounds right. We also have had a couple of years where the Santa rally hasn't been delivered. Everyone thinks like, oh, Santa rally is after Thanksgiving. The actual Santa rally is December 24th through New Year's Day. So like the Christmas Eve to New Year's Day window is usually like a 7-day trading window. That's the Santa rally. And the last couple of years it hasn't been delivered. But when you're up 20+% for the year and still closing at 20+% of the year, last year the market stumbled 6% during December, and it was still up 20+% for the year. Because we stumbled, then we kind of grounded.
I remember that we were doing
right back
Fed
up to
meeting
highs.
when it really dropped. Remember that?
Yeah. Yep. It was. That was FOMC day, man. That was like Powell kind of went off script for the first time in a while, and that was a wild day for sure. I'm looking at a trade. I might be closing out here for some profit. 1830. I'm up like $60-$70. This trade, it's a pretty good trade. I'm risking $105 to make up to like $1,800. I'm not planning on holding this thing all day, but if I can sneak a $70, $80, $90 trade, or maybe $100, I'm going to try to close this thing out. So I'll keep an eye on that one. Price is dipping a little bit. I was looking to see if we fill the gap today around 68.90. If we do, that might be enough for me to get the profit that I want for a short-term trade. It is noisy. Are we gonna queue up Powell at 2:30 or whenever he comes on? And
we are. Yep, we're gonna throw him
talks
on
out of both sides of his mouth.
Yep, exactly. Real quick, if I could just jump on here show you some of this data here we got. My goodness. So oil, for those of you guys who are Edgefinder fans, by the way, let's do this. I haven't announced it today, but we've been talking about it all week. Edgefinder's free to use till the end of today. We've been doing this all week, but if you've missed it up to now, here is how you can use our tools for free for the rest of the day to scan markets. I know it's not as long as the full week, but unfortunately, latecomers, You still got a chance to try it for a couple more hours here. But if you want to try out the Edge Finder, maybe what we can do here is, James, if you don't mind, yeah, there we go. We got the link to the Telegram channel. Inside of the Telegram channel, simply do this. Go to the Telegram, click the pinned message. Oh, it might be gone by now. Let's just do this. I'm going to just grab the link here. Hold on. I'm going to grab this and throw it in here right now. Okay. So there's your last chance. If you are interested in trying out the Edge Finder for free, here it is. Click this link. Just fill out that form. It will send you a copy to try for the rest of today. I know a lot of people who tune into these streams have wanted to try it before. There's your chance to do it for free. Okay, so with that said, oil, Dow Jones, Bitcoin, Nasdaq, I'd say this is still looking pretty risk on for now, following the trends that we've been in for a while. In terms of Bitcoin, if we take a look at Bitcoin, you've got a little bit of down move here, but Bitcoin has been kind of a disappointment for relative to risk on. I mean, you would think with Nasdaq ripping, Bitcoin would be doing a little bit more, but this maybe goes to the breadth of the market here that we're seeing. You know, not everything is rallying. It's just a couple handful of really big stocks that are doing quite well, like Nvidia, etc. Dow Jones, S&P 500, Nasdaq, I would say trend clearly to the upside for now. We'll see if that maintains the case, or if what we were just talking about here a little bit with some of the gaps that have been left open, are we going to get a little bit of a trail back and retest into some of those gaps? We've left multiple gaps open here in terms of recent trading action. Gaps opening higher, of course, on some of the overnight announcements, the earnings that we've been getting. You know, by the time market opens, market already kind of gapping higher here. So we'll see. Another one that I'm watching personally, Chris, and I'm curious your thoughts on this one. I'm looking at oil. I'm still watching for a bit of a breakout here, but I like the idea of oil trades higher. Just looking for a little bit more confirmation. Part of the reason for Edge Finder's bullishness here, I'll just pull up oil for a second. Been playing around, been working pretty hard on this AI scanner here for oil. Let's take a look. Technical signals still to the upside. You've got seasonality to the upside. You've got daily chart trend to the upside. Institutional activity. From what we have, institutions have been buying aggressively on oil here in recent times. Sentiment, crowd is a little bit bearish on oil, according to the put to call ratio data that we have. Inflation statistics, a little softer, suggests more rate cuts could be positive for oil prices. Economic growth, GDP versus forecast. ISM manufacturing PMIs was better than expected. Retail sales. I like the story for oil. I think there may be a good demand side to oil. What do you think, Chris? Do you think oil has upside?
I think we've got to be open to prices going nowhere for the next 12 to 24 months, and we just continue to operate in this like limbo of like it can't go too low, can't go too high. But I think that right now that you know, a US oil floor around like $55 is pretty solid. I've got trades in, like my future trade on CL is the floor for me is 50. So as long as we stay above 50 by December, January, that's a nice little winner for me. Here's what I'm doing on oil, and same thing on natural gas. I'm looking at plays out to like 2027 and 2028 to be long on them and going to dollar cost average. I think that if this demand for everything right now with this build out physically is insatiable, like we cannot give enough energy to, you know, we don't have enough computing power. We don't have enough energy to do what we say we want to do. So I do think that makes this for either one, there's so much demand, it drives prices lower. But I'd say if we broke this, I mean, this is just an interesting read here from this high in 2022. If this is one big swing and we actually hit symmetry, if we break the floor at 55, I could see oil falling to like sub 40. But dude, I'm going to buy a heavy amount of oil. If we're going 40, 35, $30, I'll kind of back the truck up on oil and load up for a nice little allocation. I think that's because that could be a long term. I mean, you could be long in that for years to come and potentially, you know, double your money. So, but I think right now we've got a strong floor at 55. I think we fluctuate between 55 and probably 65 or 70, but no major breakouts higher. I think it's still going to be very contained by supply and demand.
It's an interesting concept because with oil, like my opinion on it is with oil prices around $50 to $60 a barrel, the thing is, can it go lower? Of course it can. Markets can always just
we need inflation too. Inflation numbers, it has to go lower. If we want to see better inflation numbers, we have to have lower oil. If not, like our whole inflation narrative of like, you know, we've tamed inflation or we're taking a victory lap and saying that it's a lot better than what it used to be. oil's the only reason that we are not having like 4% CPI readings, in my opinion, because oil's been dropping or
Sure.
oil's been steady.
Well, and the thing too, I wanted to add with oil prices is like, okay, this concept of a floor is always a dangerous precipice because people are
For
like,
sure.
oh, but they can't go lower than that. Well, it can go lower than that. But let me just outline, like, if you think oil prices are going substantially lower than where they currently are, I would raise you and say, well, that probably comes with a recession. Like, that's if you want severe lower prices in
course.
oil,
Yep.
that is recession territory. And
Yep.
I personally, at this time, again, I am not a crystal ball owner. I'm looking at the data that I have now, economic data that we have cross globally right now does not, at least from what I can see, doesn't suggest impending obvious recession. And until it does, I think it's a dangerous assumption to say, oh yeah, no, we're going to go into a massive recession, so short oil. I think that economies can hold up. You could have a period where we slow a little bit on growth, which is sort of the projections, right? Projections globally are for economic growth to slow. But remember, I say this often because sometimes people get this mixed up. Slowing economy does not mean crashing economy. Slowing economy means, okay, we've been doing this. Maybe we're going to go into this. And from there, maybe we go higher, maybe we go side, maybe we go down. But that could be, a year and a year, 2 years out. I think right now projections are for the economies of the world to slow and then potentially to accelerate from there. At least that's what growth projections seem to be over the longer stretch. We'll see. Those things are really hard to predict. The economy, the future is very hard to predict in general. But to me, that would suggest limited downside for oil prices and a potential for a lot of upside in oil prices, especially given our starting point with oil at this time is that everything is assumed to be okay geopolitically. And if you get any surprises geopolitically, Taiwan, China, Russia, Ukraine, Middle East, like we've gone on this path here recently of a lot of deals, a lot of ceasefires, a lot of agreements. If anything gets derailed there, oil prices likely move higher.
Yeah, I think that right now I would say that the near term, in my opinion, is higher oil because everyone hates it. Everyone thinks oil should be down lower. Everything. I mean, I think it's like you said earlier. You're contrarian by nature, so I think right now I like the idea of being long oil because most people are short. I think it's a crowded trade. Any thoughts on, speaking of like contrarian and kind of going against the grain? What about the dollar DXY? I zoomed way out in this chart here. Let's go. Your chart's probably cleaner than mine because I get a bunch of crap on mine. But let's go monthly to DXY so we have some history. I don't remember if we talked about this maybe last week, but if you go back to DXY, you can go to this chart back to like 1970s. Nick, we're literally nowhere different compared to like 1970 to now. Like our price is the exact same in the DXY. Now, yes, there's been, fluctuations and big moves. But I'm curious if you can see through my art here, if we can go, is this a channel that we're actually finding a bottom in the dollar? Again, you talk about if we have a recession, if things get really bad, I could see the dollar having a huge run to the upside. And that's going to be one of the more contrarian plays because everyone thinks the dollar's in a secular bear market. The dollar's going to be down permanently. Trump wants a weaker dollar, blah, blah, blah. Maybe. But if we don't get what we want, I think that's where there's potentially some, asymmetry with a crowded trade that's just too short right now. So anyway, thoughts on that? Do you like any technicals on the DXY? I'm just looking at a bigger picture, but curious what you think on the dollar.
Yeah, I have a long position on UUP
Okay.
that I've been stuck in, or sitting in for a while. I think dollar index has just done nothing here recently. It's been probably the most boring. Currencies have been so boring here recently, in my personal opinion.
For sure.
They've just not been moving very much. Everything else seems to have a lot more volatility to it. I mean, as per usual, but especially recently, dollar index just not moved anywhere, just back and forth. I do tend to think that in terms of central banks, the U.S. is on the more positioned for hawkishness side than the rest. I think that, I'm a macro guy. So when I answer these sorts of questions, I'm going to give the thought process of who is more likely to hike rates. That's the simplified, like most likely to hike rates across the central banks. I would give you probably not Bank of England, probably not. I mean, they can't. Their economy is in the bin right now, as they would say. Europe's also struggling. You have the Swiss franc actually looks quite bearish to me, in my personal opinion.
Good.
Yeah, like I think I hope so. Right? I
Yeah,
would
me
love
too.
to.
2 years.
Got a
2 years
couple.
of hope.
Yep, I've been sitting
You know
in
that saying.
some
Hope
of the
in one
same.
hand, and yeah.
Right. Yeah, but I think like just in general, I think dollar has upside because when you compare it to the other central banks, the ECB looks like it would be more likely to cut than hike. The RBA, the RBNZ, Bank of England, just in general, we have more growth in the US than other places. Inflation is sticky, but combined with strong growth, that's a scenario where I just don't see a ton of rapid rate cuts at this time more than our peers, right? Remember, when we're trading currencies, for listeners, this is an often big mistake that people make, is they look at currencies in isolation. They look at the dollar and say, oh, well, the US economy is going to slow. Okay, well, how about its peers? Because you can't look at just the dollar and say it's just about the US economy. No, it's US economy versus comparables, right? And so if you're going to say dollar is bearish, what you're saying is the US dollar is more likely to struggle. The US economy is more likely to struggle, more so to the downside than expectations than its peers. And currently, I would sort of kind of take the other side of that. I would say that there are some currencies that look surprisingly strong, like the Canadian dollar here recently, the Australian dollar. But then you have a lot of peers like Swiss franc, euro, that look a little softer. But I wouldn't say I'm like aggressively bullish dollar. It's not like a top trade for me right now. Like I said, it's sort of a boring one sitting in the background. Are you thinking if dollar does have upside in your view, is it a lot of
I don't know.
upside or is it some?
I mean, I probably have to trade something that just has ridiculous amounts of upside with a small risk. That's about the only way I'd like to trade it, where it's like, if I'm wrong, I'm wrong, easy, early, not a lot of risk. And if I'm right, let the thing run and get paid a lot.
Yeah.
I've been saying this all years, like currencies have been pretty boring for the most part in 2026 or 2025. Obviously that changes very quickly. Like we could have something wild and crazy happen with the Bank of Japan or this combo with the Fed and then BOJ maybe before the end of the year. The surprise prime minister, we still haven't filled that gap, which is kind of interesting. We came back to test where the markets opened on Sunday night, but we still haven't filled that gap. I think that the Japanese yen is still on my radar for what is probably a huge trade at some point. It's just like, this is the hardest part, is I can plan this trade and have it drawn out on my charts and be ready to take some action. But I'm not touching this thing until either one, if my drawing tool is not working. If one, this is dollar yen. If we're sitting here in the dollar yen up towards these highs again, we have resistance here. Maybe, Nick, I take a chance at this area to sell and sell really small. If I'm right, we go down to the channel lows. If we break that channel, we come back down. It's just a big range. This would be resistance. This would be support. That could be a 2,000 plus pip opportunity and high volatility. Again, all these type of trades, if we have dollar index up or Japanese yen getting stronger, none of these things lend their hand to risk appetite, right? So like, that's the one thing in the back of my mind. I'm like, if the market just keeps like melting up higher, like this will never materialize. The dollar won't go anywhere. It's like the longer that currencies can just range trade, it's like the market just isn't shocked. There's no aggressive rate of change, where it's just what has been driving the market is path of least resistance and more of a melt up. So anyway, dollar yen, it's like, I want to keep an eye on this trade. I think that Swiss yen might be one of my favorite technical trades, but it's not confirmed yet. So here's Swiss yen. I did say for a couple of the videos that I posted, I want to sell the Swiss yen, but right now we haven't broken any of this structure. So there's still a gap here to fill. And if we take out this low, I think this is an excellent pattern to then start stacking in some shorts, get filled, stop loss above the highs, and then plan on a symmetry move that maybe gets down to 165 or so. That's a 185, 188 down to, it's a 2,000 pip opportunity. Again, looks good. And this is the only one that I'd like because it's actually positive swap, or the one that you're not going to get charged for every day from your broker.
I was going to say, Chris, I listened to I'm a Rob Booker super fan, but I heard
Yep.
him talking about something with currencies probably 6 months, a year ago or something. And
Okay.
he was like, the only trade in town is interest rate divergence differentials in currency land. And I realized I totally agree with that. Like in terms of, he's talking about like zoom way out, long time frames, compare the two economies, compare the two, the interest rates of the two, and play that swap. And until it doesn't work, right? Until the carry trade unwind takes place, then you gotta know when to jump out. That's the finesse of currencies. It's like, if I'm gonna talk about long dollar Swiss, I mean, everything Swiss franc has been frustrating, but let's just say, if you get an uptrend in the dollar Swiss franc, it's about knowing when to bail or when to time your kind of scaling out, that sort of thing. So, I have a short position on Euro Swiss. I mean, currencies for me, like I said, I have really small positions on, and all of it is like monthly and weekly charts for me, to be honest. It's very high time frame stuff. I'm long CAD Swiss. I have Euro pound shorts. And these trades are really small. So I'm just sort of sitting in them, collecting positive swaps. And, maybe 2026, like you said, maybe there's a little bit more volatility that comes into currency land. But right now it is just.
Well, I just want some technicals too. It's like, I mean, look, man, and I'm not patting myself on the back for riding out Swiss pairs for 2 years, because I've just been sitting in like these, hey, congratulations, I'm getting an extra 3 to 4% to my bottom line as I'm sitting and nursing drawdowns. They're small and manageable, but it's super frustrating to watch. CAD Swiss, especially New Zealand Swiss, dollar Swiss, like they haven't given us a bottoming pattern that has been sticking. There's no bottoming pattern, right? Nope. I think at some point it's like, do the technicals matter where the Swiss isn't going to be in a 2 to 3, 4 year strength, like strong trend? If they bottom and we get like a 3 to 5 wave move, I'm just looking back at like pure technicals and Forex. I miss them. I haven't seen them for a while.
I mean, these Swiss franc moves have been just one directional.
Like zoom out on New Zealand Swiss and CAD Swiss. That's like a 5-year bear market, dude.
Yep, it's crazy. I mean, that's the thing is, you just look at like most currency pairs. Swiss franc is sort of the exception to the group. Most currency pairs just back and forth. But the Swiss franc has been so strong for so long. Will it last forever? Probably not. Well, definitely not. Eventually, it will change. And again, this is where, as you pointed out, the key game is if you're going to play currencies where you're sort of scaling in, scaling out, long-term carry trade type of approach. It's all about position sizing, and it's all about just being patient. I mean, there will be an opportunity where we'll get another leg like this, and that long-term stuff can play out. But again, it's I go back to what I said at the beginning. It's like currencies are super boring and just sitting in the background. They're playing a really small part in my overall portfolios, and I imagine same thing for you right now, Chris.
Yeah, it's definitely in the background. I still have a couple of clients that are in currencies with me, my personal account and some clients. But again, it's pretty low maintenance, and that's fine. It's like the difference is like, that was like exclusively what I did for a decade. And now I've, once I started incorporating, stocks, options, indexes, futures, Forex, like, I mean, it's just one fraction of what I do now. And so I've intentionally made it where I don't want it to be high maintenance. I don't want to be in and scalping. So somebody asked me the other day, I'm looking to scalp. What do I do to day trade? I'm like, I gave them my system that I started trading with back in 2007. You get a 1 hour chart, get a couple moving averages that you like and you rely on. You go from a 1 hour chart that's always going to be your North Star direction. If it's above, above all your trend lines, you're a 1 hour bullish chart. Then go down to your 15, 5, 3, 2, 1, whatever you want to execute on, and just get them aligned. So if 1 hour lines with 15, and then you get your precision off the smaller time frames, you can scalp 5, 10, 15, 20 pips most every day. But then it became, okay, well, what window do I trade? Well, where do you live? Do you want to trade the London session at, if I was trading the London session when I started doing this crap, when I was in Miami, Florida, I was trading at 3 a.m, and I did it for years, and it's like, fine, because that's what I was doing. But it's like, I don't want to get up at 2 or 3 a.m. now to trade. It's like, so my whole life has been just way less stress as a trader, where it's like, I don't get up at 2 a.m. to trade. I don't get up at 3 a.m. to trade. Also, it's like, well, Chris, just trade the U.S. session. The U.S. session sucks compared to the London session, in my opinion. But it's not every day. It's not. So that's what was so difficult about the markets. It's like, if you want to try to trade the consistency of like U.S. markets for 2-3 hours every single morning, you never get guaranteed volatility. If you want to trade the London session every single day, you never get guaranteed volatility. that is frustrating, especially when you are a day trader, because what you end up doing is forcing trades.
Yep.
And so let the market come to you. Like a great day to trade Forex, if you want to scalp, is a day like today when there's going to be a lot of volatility. Powell's going to jump on here and talk in a few minutes, and maybe the market gives us something. I haven't seen any crazy stretches in the currency strength chart. Like nothing's really jumping. The dollar's getting a little bit of a bid here these last few minutes, but that's all I see. But that's it, man. Like, I don't know. I just think it's tough to force yourself to trade a window that like doesn't guarantee movement every single day, and you just end up over trading. So
yeah, I mean, I'm the same thing. I mean, there was a time, 2022, where currency was making up a lot of what I was doing because the dollar had so much volatility to it. There was some moves I could play it. I've just really dialed back on the currency trading recently. Anyways, Chris, we've got just a couple minutes here before we get into listening to Powell. Let's get to the real meat and potatoes here in terms of what everyone cares about here in the audience, seemingly. Right. What do you think on gold? Gold and silver have had, let's just take a look. Percentage-wise, peak drawdown was around 11.26%. At this time, you got about 9% off the highs. Silver pulling back at 1 point, down 16%, currently around 12%. Moving averages wise, 20-day moving average got tested, nothing else yet for silver. Gold moving average wise hit the 20, didn't hit the 50. We are seeing, a lot of deals go through. Trump administration, all that stuff with the Chinese trade dynamics, some of the uncertainty of the Trump administration. And again, if you're a critic of them, you'd say the self-imposed has been pulled back. But here's the question for you. Is this enough? Is this where you, and it tells a little bit of your perception of the markets, I would think, is if you look at this market and you're like, oh, that might be all we get for gold, buy it here. Or if you think wait lower, then, maybe you feel like the market can have a little bit more risk onto it. I think that this is a risk on induced pullback in gold. As we know, typically gold does well in uncertainty. So I'll give you my quick answer. I think gold has a little bit more room to pull back, and I think it's had such a wonderful run this year. Again, congrats to every single person who's a precious metals bull. If you hold it long term, this has been your year. Let's take a victory lap, and let's be very, okay with the idea of a little bit of a pullback finally.
For sure. Here's what I think technically. We are still, Nick, not hitting a 200-day moving average. We're now over 500 bars. That 200-day moving average is going to get hit. I'm not saying we have to go down to hit it, but I think we will consolidate and go sideways. If gold is going to remain fairly bullish, then we will consolidate again. So we had this run consolidation. This run, does it consolidate again? If that's what happens, where this consolidation, so we either go high, low, lower, high, lower, low. I love the idea of buying those dips. If we have another leg lower, I'm all over those dips. And this is what I put in for Pulver alerts, CEF, PHYS, GLD, SLV. I'm buying all those positions. So if that's another high, low, lower, high, lower, low, I'm scooping up some more dollar cost average levels. If we go sideways, let's say that this dip is aggressively bought. So we go high, low, right back up to the highs again. Watch for sideways, watch for broadening pattern. And then my moving averages here, this is the 100, the 144, the 200. If they catch up, you use those as dynamic support and you can establish that core position. And, I think if we're looking out 3, 4, 5 years, gold's at 10,000 an ounce, maybe higher. Silver's probably trading at $100, $150, $200. I like both of them. I think they're both great to have in the portfolio. I think this year has shed a lot of light on where the world now thinks that these precious metals, strategic metals are going. This is the first time in a long time that futures markets, people are wanting physical delivery of
Chris,
the asset.
we've got the big man on the stand here. We'll switch over. Yep.
And I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting,
Hey man, we got some pretty aggressive price action going on.
Differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion in your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month, and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
You know, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a little bit or a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, you know, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, you know, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, you know, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, you know, that would certainly play into our decisions going forward. So, we do have, you know, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get, you know, job openings. And we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market. And, you know, the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So, you know, we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the, the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's, I guess, 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percentage of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say that first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Chris, I'm going to be shutting it down here. I've got to jump onto a trading battle here. I think we got through most of that data. A little bit more hawkish than expected. I would summarize. I posted it in the chat here. A little bit more hawkish than expected, I would say. Powell kind of reiterating that the committee is split on forward projections for interest rates, that there's people on the group that are more poised towards inflation, towards jobs data. So interesting little sell-off. Bounce here now in the S&P 500, dollar shooting up pretty sharply, and gold initially moving lower here. Kind of, I would say, neutral to hawkish. Is that a fair?
I think when you take away the hope of a December cut, make it a little bit more vague. I'm going to see what the CME watch tool does, or the futures watch tool does for the Fed coming into tomorrow's trading day. Watching this huge sell-off, actually, it came down to my level. I was looking at 68.50 for the day. It hit it to the tick, which is good. That's why I pay for the software that I have. So we took a nice little profit on that trade. But now that it's bounced back up, I'm just looking to see, okay, I'm going to try to get either a top or a bottom position with a bit of a profit trap. Maybe it's noise. It probably settles in. If we don't break fresh lows or don't break highs again, it's just a typical noisy Fed day, which we see all the time. And it is what it is. So, more to come tomorrow. Mag7 today and tomorrow. So just be wary that, this might be noise for the Fed. And then it's all about Mag7 earnings to see how the week finishes.
Yep. It's not over from here. Chris, I got to kick you off. I got to jump off myself. Thanks for coming on, and we'll see you on the next one, man.
Yeah, bye.
All right, guys. So I am jumping off now to start a trading battle. We are going to be doing a live trading battle with three of us, two professional traders going head-to-head to trade the post-FOMC. If you want to see trades being placed right now based off of what we just heard, as well as further commentary, if you want the discussion, post-Fed discussion, I will be doing that right now on this link that you see right here. We're going to drop the link one more time. Join me here. Click this link in the chat. Follow me over to this trading battle. I am jumping over there right now. And then we're going to get right into trading the aftermath. This is where things actually get interesting. Now that we've heard from Powell, what do we do about it? We are trading that using this link. Come join me over there. We are going there right now. See you on the other side. Going to end this stream. Click that link. Join me there.
You've been watching A1 Trading Live. We're here Monday through Friday, where you can tune in to hear insights from professional traders from all over the world. Make sure to subscribe for future streams. And as a reminder, if you're looking to get access to free courses, prop firm discounts, and free trading tools, head over to a1trading.com. See you next time. You've been watching A1 Trading Live. We're here Monday through Friday, where you can tune in to hear insights from professional traders from all over the world. Make sure to subscribe for future streams. And as a reminder, if you're looking to get access to free courses, prop firm discounts, and free trading tools, head over to a1trading.com. See you next time.